The topic for today is whole life insurance. We're going to discuss the cash value, but specifically how people use their whole life insurance policies. This is a question a lot of people ask, typically in the early stages. For example, you're researching whole life insurance. You hear some good things, you hear some bad things, and what you would like to know is simply, how do people use these policies? If I can see an example of how others do it, then perhaps it may be a fit for me. So we're going to cover exactly that today. So when we look at a whole life insurance policy, there are several things I want to hit on here, but beginning with the cash value, because this is always the point of interest right here with everyone we work with. The cash value, how does it work? We've got our three core benefits here, being that the cash value is safe, liquid, and tax-free. Safe, to provide some information on that. The cash value in a whole life insurance policy is a very safe area to position funds. As we look at the cash value in a policy, it will continue to appreciate over time. When we look at the history of whole life insurance, anytime there's been a major recession or a stock market crash, cash values in whole life insurance policies tend to continue to increase. That's because I've got guarantees associated with the product. There's no risk, meaning it's not tied to the stock market and such. It's a very, very safe area to position funds. The net growth rate, this is often referred to as the internal rate of return in the life insurance industry. If a policy is set up correctly, that internal rate of return will typically range somewhere between 3 to 5%. And remember, that is consistent regardless of what's going on in the stock market and economy. So it's a 3 to 5% without any risk. Historically, we have seen policies do better than that, but we do like to shoot things conservative. Liquid, I can access my cash value anytime, and there's a unique loan feature to a policy, which we're going to hit on a little bit when we go through how people use policy loans. To summarize, when I look at the liquidity and the loan feature of a life insurance policy, what's attractive about it is A, I can get the money very, very quickly. On average, when I request a policy loan, it's anywhere from 2 to 5 business days before the money hits my account. But then second, my money continues to compound. So if you've ever invested in real estate, let's say you own an investment property or you own a home, and we'll pretend that the fair market value of your property appreciates at 5% every single year. So if you elect to take a line of credit or take a mortgage out on your property, let's say for 50% of the equity, if your property value continues to appreciate at 5%, does that 5% appreciation occur on your entire property or only the remaining equity? Your entire property. Now, of course, you pay loan interest on the outstanding loan, but you're still earning that appreciation on the entire asset. Very similar with a life insurance policy and how the cash value continues to compound. And again, we'll provide more detail on that shortly. And tax-free. Tax-free if we do things properly, if we do not trigger a taxable event, such as a modified endowment contract, or such as cashing the policy out when I have a gain, or letting it lapse with a large loan balance. That can potentially trigger a taxable event. We've got several videos that go into detail on the different taxable events with whole life insurance policies. Then we've got the death benefit. Death benefit proceeds are always paid out 100% income tax-free. They are not automatically exempt from estate taxes. However, life insurance is very, very heavily used in estate planning, also business planning. And also what you'll see from a legacy standpoint is a lot of times individuals will set policies up where a trust is the beneficiary. Sometimes the trust is the owner of a policy as well. But when you hear the topic of generational wealth, often what people are using, or I should say how they're using life insurance policies or life insurance in general, is if that death benefit, say it's $1 million or whatever the dollar amount is paid to the trust, and you have that trust written in a manner that states these proceeds must be used to purchase more life insurance on the family, invest in real estate, however you want the funds used, you can stipulate that. So my point is, leaving large income tax-free proceeds to a trust and then specifying how it should be used is a nice way to continue to build generational wealth. You'll see that practiced quite a bit And there's a lot of good estate planners and tax attorneys out there. One of my favorite firms is EMA Legal, Elizabeth Morgan and Associates, which we've got some podcasts with her, but they're very, very good at what they do, including their partner firms. But let's get into how people use whole life insurance, specifically on the cash value, because we hit some of the features there, which are very important to be aware of, because that would be the why I'm interested in it. Now let's go through how people use it. 3 main ways. We've got the funding, then using policy loans, and then income down the road. And again, this is all going to center around the cash value component. Let's begin with the funding, shall we? So when we look at the funding, typically what we see is people are interested in funding large dollar amounts into a whole life insurance policy. However, if I can be able to pay a large amount into a policy but not be billed for a large dollar amount, then the product does not feel like a burden. To illustrate, very common to see a case like this where someone wants to be able to pay $100,000 per year into a whole life insurance policy. To clarify, that's not a $100,000 death benefit. This is someone saying, I want to be able to write a check for $100,000 per year and move it into a policy, and I'm very, very focused on cash value. I want to see my cash value maximized up front, long term. I want to look at the guarantees, everything. Cash value is what I'm very, very interested in. So in a case like that, the follow-up is often this. While I'd like to be able to pay in $100,000 per year, I don't want to be committed to that forever. Yes, I can do it right now, and I can do it for the foreseeable future, but man, it's going to stress me out. It's going to tax me emotionally if I feel like I always have to write a check. There are times where my money is tied up in my business or real estate, and if my policy anniversary date is June 1st, I'm not always going to be able to make a payment on June 1st, not the full $100,000. The good news, when it comes to the funding, you do not have to do that. Did you know that you can actually have a design like this? This does depend on the company and how the product is set up, but you can have a design or setup where you have a premium of $10,000, meaning that's what you're billed for every year. You could even pay that over 12 months with some companies if you wanted to. And then at leisure, you can add money toward your PUA, which stands for Paid Up Additions Rider. And this is really the key to accelerating the cash value growth on a life insurance policy, particularly when we look at the guaranteed values more than anything else. So my point there, what people are attracted to is they like the idea of being able to pay a lot of money into a policy, but they don't want to be obligated to do so. So if we can have a policy where it's very flexible and I can commit to $10,000, even pay a little bit more than $800 a month, and then add additional funds at my discretion, okay, I'm interested in that. And it doesn't have to be $100,000. It's all ratios. What I mean when I say that is if you said, okay, let's chop off a zero, I'd like to do that with $10,000. Is that possible? The answer would be absolutely. What we would do there is set the premium at, guess what? $1,000, and that's per year. And then at your discretion, you can add another $9,000 to the policy. The same is true for the individual paying $1 million per year. They're committing to $100,000 and adding another $900,000 at their discretion. And this 10% minimum, this does depend on the company. Some companies are a little bit lower than that. Some are a bit higher. When it comes to adding PUAs, some companies will allow you to add PUAs at your discretion. Literally, you could just log onto an online portal and throw money into PUAs or mail in a check anytime, very, very flexible. While other companies may not allow that. So having awareness on different life insurance companies is very, very important. And we do have several videos that go through different insurance companies. You could check out or just search MassMutual or Guardian or choosing the right company, and a lot of content will pop up. But my point is, on the funding, we can make it very, very flexible, which is appealing to individuals. The other question that comes up sometimes is, how long do I have to pay? Because what is the name of the product? It's a whole life insurance policy. Does that mean you have to pay into it for your whole life? The answer is no. You do not need to pay into it for your whole life. You can have a policy where you can pay into it forever, But you might decide later in life to stop at age 65. Or maybe we set it up in a manner where the plan's to pay in no longer than 10 years. Or maybe it's a lump sum of money and we look at different funding scenarios and we decide that somewhere between 3 to 5 years is the sweet spot. What I mean when I say that is if I'm funding $1 million, let's say I've got $1 million in cash, and I want to move that into a policy, and we'll say 4 years is the sweet spot, what would that come out to? $250,000 per year, which is usually the case, not always 4 years, but if one wants to fund a policy with a lump sum, which is extremely common, especially when someone's interested in the cash value and they do not want to have to pay into a policy for a long time, the first question is, can I add it all in one shot? The answer is technically yes, but it will not be attractive. However, what you can do is spread it out over a number of years, and you will always see stronger cash value upfront and long-term, guaranteed, non-guaranteed, all of the important items we want to look at. That's what we're going to look at for you or anyone we work with. But it will look very, very good typically when we spread a lump sum payment out over a number of years. But on the funding, main thing there, what people look for, how people use whole life insurance, is they set it up to be very flexible. This way, you're not committed to a bill. It doesn't feel like a burden that you have to pay the same dollar amount every month, every year. No, I'm going to be able to use it like a flexible savings asset and have fun with it. All right, so covered the funding there. Let's take a look at policy loans. So when it comes to loans, we hit on that loan feature earlier where the money continues to compound, a lot like that appreciating real estate. So here's how it works. Let's take this example. You've got a policy and your cash value today is $100,000 and your death benefit today is $500,000. So $100,000 in cash value, $500,000 death benefit. You elect to take a policy loan. Let me back up actually. What's the policy growing by? We mentioned net growth rate, somewhere between 3 to 5%. Want to use 4%, pick the middle. I think that's conservative and a good number to use. So 4% net growth rate, net internal rate of return. You elect to take a policy loan. For simplicity, you take $50,000. You can typically borrow up to 90 to 95% of whatever you have in cash value. That's a question a lot of people ask when they say, how are people using this? How much of their cash value can they access and such? But in this example, to keep it simple, $50,000. Okay. You've got a cost to borrow, loan interest, that goes where? If you take a mortgage out against your appreciating real estate, where does that loan interest on the mortgage go? Does it go back to your real estate? Does it go back to your property? No, you pay it to the bank. So in this case, the loan interest goes to the insurance company. So they are making money there. The loan interest rate will typically range somewhere between 5 and 6%, depending on the insurance company. If it's a variable rate, that will adjust over time. Fixed rates can be found typically between 5 and 6%. And if it's a fixed rate, it's fixed. It's not going to change. I've got that cost to borrow. Let's say it's 5%. 5% of $50,000 is what? $2,500. Now, if I'm earning 4% before I take a loan, what does that come out to? On the $100,000 that is, $4,000. So you had the $100,000 in cash value. 4% of $100,000 is $4,000. Next, you took a policy loan for $50,000 at 5%. $2,500 was paid to the insurance company. Are you gaining more than what you're paying in this specific example? Yes. What do you have remaining in cash value that you can take in additional loans? Another $50,000. Now, when you borrow that $50,000, what happens is the insurance company tells you, we're going to continue to pay you dividends and interest on the full $100,000 as if you never touched it. So you're still compounding on everything. How they do that, 2 ways. One, they are charging loan interest when you borrow against it. And then second, what is a life insurance company's first and foremost obligation? Kind of in the name, to pay life insurance claims. So that $500,000 death benefit I had pre-loan, after I borrow the $50,000, is it still $500,000? No, it is not. The death benefit will be collateralized dollar for dollar by the amount I borrow. So I had $500,000, I loaned $50,000, now my death benefit's $450,000. So if I die the next day, that's the death benefit amount that is paid to my beneficiaries. If I don't pay the loan interest on my policy, because you're not required to do so, that loan interest, what will happen is it's paid from the policy. The policy will take a loan against the cash value to cover the actual loan interest, but my death benefit will also drop by that amount each year. And we've got case studies that look at taking a loan and paying it back, paying interest only, and then paying it in full. And it's good to see that kind of stuff before you're looking to take a loan, often before you even look to start a policy. But when it comes to loans, here's how people use it. Really, what does this remind you of in a lot of ways when you see how it functions? For many, it's a line of credit. I know I can position money in my cash value, watch it continue to appreciate over time, and I can borrow against it and pay it back at my leisure. And once I've got that cash value high enough, I can use it really as my own source of financing. I don't have to go elsewhere to institutions and such. I've got my own financing over here. This is often where people are attracted to this in many ways. So with respect to loans, how people use it is really, from what we see, as a line of credit in many ways. And one other thing people like to look at here, without getting overly technical, is tracking the value of their policy, or I should say what the cash value is growing by every year, and then looking at the cost to borrow, specifically how much is my cash value growing by every year, and how much am I paying in loan interest. And really what individuals want to see, all they want to see, is am I in a position where I'm gaining more than what I'm paying? That's really what I'm interested in. So the last piece, as far as how people use whole life insurance, is on the income side of things. This is very, very big in the corporate world when you look at corporations and small businesses using cash value life insurance, because what they're doing is funding policies aggressively. They've got the cash value as an asset on their balance sheet. But often, if they're going to take a policy out on an executive, they'll say to that executive, Mr. or Mrs. Executive, if you stay with our company for the vesting period, which could be performance-based, maybe it's to a certain age, company determines that. But if you stay with us, we're going to pay you a retirement benefit. And often, the vehicle used in these strategies is, guess what? Cash value life insurance, because there's guarantees associated with it. There's also a death benefit. But when they eventually pay that retired executive, it's very common to see them access the cash value that has been built up over time. So on the income, what I just explained there is a brief sample of how companies use it, but individuals can use these policies for income too. And here's the sizzle word. If you do everything right, I can access those funds completely tax-free. So for example, let's say your total funding is $1 million. Another word for total funding is cost basis. That's the total dollar amount you've paid into the policy. We'll assume your cash value over time has appreciated to $3 million. Now there are two methods in which you can actually pull money from the policy. One, you can take out a withdrawal, which is exactly what it sounds like. It's like withdrawing money from a bank account or another source. And when you withdraw money, it's gone. It's no longer earning dividends, interest, or anything like that. Something to be aware of here is if we withdraw more than what we've paid into the policy. So in this case, we paid in how much? $1 million. If we withdraw more than $1 million, the gains will be taxable to us as ordinary income. So you paid in $1 million. If you take out withdrawals of $1.2 million, the additional $200,000 will be taxable to you. And this is with a standard policy, non-MEC, not a modified endowment contract, nothing like that. So how you get around that and use it tax-free, because this is what's interesting to people or of interest, is like this. I would withdraw up to $1 million. And then if I still have, call it $2 million left after that in cash value, then I would begin to loan out the rest. And when I'm taking policy loans, loan interest does not need to be paid out of pocket, meaning I don't actually have to dish money out to pay that loan interest. Now, if you don't do that, you will see it impact the cash value and the death benefit. But my point is, what we'll do with these strategies is look to take income on a tax-free basis. It'll be a combination of withdrawals and loans. And really we'll look at what's the maximum dollar amount we can take in income without risking a policy lapse. Meaning we don't want it to implode, because if it lapses, that could trigger a taxable event. Sounds scary, but it's very, very easy to prevent. It's really just looking at different scenarios, meaning what's it look like in a best case scenario with the current dividend rate and everything just humming? And then what does it look like when we kick rates down to a conservative dividend, or even the guarantees? If you want to say, show me ultra conservative, no dividends, just show me, can I get more money out than what I paid in? The answer is typically yes, if we do everything right from the get-go. But people will use policies for income, and also what the point of attraction is here is this guy. And again, that's if we do everything right. So I hope you enjoyed this video. If you did, please let us know. Please feel free to leave a comment below or hit the like button and subscribe for more. And as always, I hope this helps. We'll talk to you in the next video. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.